Hello, everybody, and welcome to our second Quantitative Financial Econometrics seminar of this semester. We've all been focused on climate change and its impact on the financial system. And today we're very privileged to have three guests from the European Central Bank in the area of macroprudential policy and financial stability. Paul Hiebert and his colleagues Spyridon Alogoskoufis and Katarzyna Budnik are all here to tell us about the work that they are doing on climate scenario analysis for the European financial system. So Paul, Spyridon and Kata, the floor is yours.
Thanks a million, and thanks for inviting us to present today. I'm happy to have all feedback at this stage. For us, it's still pretty greenfield what we're doing. And as we move along, we're really learning. And I think part of that learning comes from this type of dialogue. So today, what we wanted to present is some of the work we've been doing here on trying to further climate scenario initiatives. And we've been doing it here, I guess, in two parts. And we're going to kind of cram it together in one presentation, which is the underlying element is that we have measurement that we're using in terms of mapping out exposures. And then we want to bring it forward in terms of scenario analysis with banks in mind, which is what the ECB has done in earnest and published a piece, which you'll see referenced in these slides earlier this autumn. And also we've been doing it for the non-bank financial intermediaries on a consistent basis, which I think is a nice element we can do, leveraging the membership of the European Systemic Risk Board. Now, for those of you not familiar with that, it's the logo on the upper part of the left-hand part of this slide here. It is the equivalent of the FSOC this side of the Atlantic. And whereas I think you benefit from a great richness in your agencies in terms of diversity over here, I guess the same is probably true in a set of countries. But what is true in the European Systemic Risk Board is we have the insurance regulators and the markets regulators alongside the banking ones. So it's quite a nice group in terms of allowing us to leverage that particularly large membership. Now, on the next slide, what I can give you is just an idea of what we want to go through. Then I've kind of hinted at this. Largely, the basis for any scenario analysis is good measurement and data to start with in our initial conditions as we stand. And that's the one I want to go through with some exposure mapping, so linking several data sets, which has been important for us. And as we move away from our familiar territory of, say, financial and economic, and bring in this third climate leg, which I think is obviously for all of us the new one in the block. The second part would be Spyros will take over and talk about what we've been doing specifically here at the ECB when it comes to climate stress testing of banks. And the third part will be Kata, which will jump in and go to the extension to the broader financial system. And when I say that, I mean both in terms of institutional membership. So the European Systemic Risk Board does have this broader markets regulators insurance side, so we can do those types of exercises alongside banks, but also when it comes to expanding to non-bank financial intermediaries, that would be inherent to that too. So with that in mind, I'd go to the next slide and get started on the exposure mapping. So I mentioned that's the foundation of what we do. And basically we want to do the following. We want to match three separate types of data: financial, economic, climate together. And that required quite some work on our side with firm identifiers and the like to try and really get down to, in each of these data sets, how do we uniquely identify firms? It's very granular. It's the level of firms across these three different data sets. So basically what you see reading left to right in this particular slide, we first start on the side of climate. And that's the two white bubbles on the left with the arrow underneath. And that's physical risk and transition risk. We basically went to external providers here. So Moody's 427 on physical risk and Urgentum on transition risk. And ultimately on each, let me just say a few words, it's 4.3 million firms which are geolocated at the address level is on the side of physical risk. So they have a physical risk score which they're assigned based on their location, and it's address level here to the extent that it can be done. And what that means is you have some spatial extrapolation where you have some missing information, but otherwise it really is attempting to get down to where the firms actually have their operations resident, not the country of HQ. On the side of transition risk, it's about 5 million firms worldwide. It's listed and unlisted firms. And what this provider has done for us nicely is it has emissions across all scopes, not just scopes 1 and 2, the familiar ones, in terms of what you produce, say, for diesel car on production and all of the inputs, but also downstream, the use of that diesel car as it goes into consumers' hands. And that, for this data set, it's around 85% of the world's overall carbon footprint by our estimates. So these are important estimates to bring into the mix. And of course, they are estimates in many cases, which I think is unavoidable given the state of disclosures. So second, on the side of financial inputs, we take these left two bubbles, physical risk, transition risk, the climate metrics, map them into firms' financials. The usual, this is where it starts to get more familiar territory for economics and people in the financial sphere. So Orbis, Icon, Bloomberg, IBOC, these are all databases which have firms' financial information, balance sheet, and performance. And what we do with all of this is take it to the side of banks, which is the third block under financials. So we take identifiers in the form of ISIN codes or whatever we can in terms of RIAD on our side is what you call for effectively firm identifiers, map to bank level individual exposures, and that's using AnaCredit, which is our credit registry here in Europe. So any exposure of a bank in terms of loan exposure over 25,000 euros gets reported systematically in AnaCredit. And that allows us to take around 4.2 million firms in the euro area, which are matched at the bank loan level. And then we can do that also on the security side. So not just loans, but securities. And that's a securities holdings database, which is around 6,000 firms in the euro area. And ultimately, it's these two blue boxes you see at the end, which is what we have in terms of the matched data set. So 2.3 million European firms and around 400 consolidated banking groups or 1,600 unconsolidated banks. So next slide basically tells us moving away from how we do it to what we find. So and I'll just go through these quickly before getting to scenario analysis. Again, I think it's useful to have the basis here in terms of data up front. So physical risk first is basically we see, and you wouldn't be surprised, with a regional concentration of exposures. And there is some correspondence to country level attribution of operation. I'll come around to that. First, on the left-hand side, what you see here is this regional concentration of risk is quite substantial. So this heat map takes the shares of a euro area firms exposed to 6 risk hazards over the next 20 years, and whether they're high, increasing, or they're into some category. And you see the darker reds, which are the high, and the orange, which is increasing, have quite a strong regional distribution. And what we see in terms of, in the right-hand side, is taking those into the individual climate hazards. So across 6 of them, hurricanes or storms on the left, not really an issue for European countries. Sea level rise over the 20 years that we have in terms of look forward on these physical risk scores, also not huge. Although obviously in the second half of the century, that could be rising with chronic risks. But it's more on alongside floods. The third column you see on the right-hand side heat map here. Now, these are all the euro area countries listed on the left-hand side, the y-axis there. And what you see is a lot more orange colors. So it seems to be fairly widespread, but not extreme. But if you mix it in with water stress, heat stress, wildfires, those 3 last columns, you see a lot more red, and the red seems to be distributed more along the Mediterranean basin here. So it's more specifically geographically attributed. So that has some relevance for us. Now we go into the next slide. What we see is that you obviously would say that, okay, these are all largely gross measures. There's limited micro-adaptation baked into some of these physical risk scores. What about potential mitigants? You know, firms don't tend to lend, so banks don't always tend to lend uncollateralized, and these exposures might be insured. Well, both we have grounds to be a little bit concerned ex ante, and let me talk about each in turn. So the role of collateral, left-hand side, what you see here is by industry in Europe. What we see is that obviously banks tend to secure loans with collateral. That's obviously something that they like to do. It differs across industries, so a bit less in manufacturing, a bit more on the side of real estate. But obviously what we're concerned about is this potential for wrong-way risk. We would have potentially damages from climate causing it from the default and also impacting the collateral, physical collateral used to secure those exposures. So you could think of PDs and LGDs both being impacted in this case. Or you could even think of fire sales, even in the case it doesn't directly impact land, but some proxies start to be impacted. Now, obviously, then you think about real estate construction, 80 or 90% is collateralized. So that lending portfolio indeed might not be necessarily safe ex ante as you might, exposed as you might think ex ante. Now, what's interesting, I think, more is on the right-hand side here, to think about insurance protection gaps. So our colleagues at EIOPA, which is the insurance regulator, part of our umbrella group, the ESRB, did estimate when they went out to have a look that 35% of economic relevant climate losses in the EU are estimated to be insured. So the first raw estimate of an insurance protection gap now, not looking forward, is around 65% of economically relevant climate losses. So it could be potentially quite large. So again, the gross might be a relatively good indicator of the net exposures. Next slide, and last one before I pass on to Spyros, is just going away from physical risk to transition risk. And of course, Spyros is going to treat the two then in a consolidated framework where we look at both. But let's start with the cross-section. It's here just to say you could look at the level of sectors for transition risk as being the relevant metric, less about regions. And on the left-hand side, it goes into the economic sectors across sectors. So where we would see that the distribution of scopes of emissions on banks is pretty heterogeneous across European sectors. The biggest contributors, no surprise, is manufacturing, which is the yellow here, electricity and gas, the dark gray, and transport and wholesale retail activities, which is the red. What you see is bank loans are pretty well diversified across the sectors. It's this third bar from the left in terms of exposures. But what we do see is that if you combine them, manufacturing, wholesale retail, around 1/3 of bank loans, and around 40% if you put in transport, electricity and gas. And again, the scopes do matter. So it tends to be manufacturing or dominant scope 3 industries, versus electricity and gas, obviously scopes 1 and 2. So you really want to consider the cross scopes to think about the prospect of repricing potentially hitting some of these exposures. And indeed, I didn't talk about it, but we could go at length. I'm sure you've seen in some of your seminars the same thing, which is you have financial prices in the markets are not necessarily pricing in earnest major impacts of climate as yet. And when those do eventually come, it's interesting to note, could these lie in particular sectors, or in the right-hand side chart, could they lie within sectors? So these are box plots telling us about the emissions intensities within these given sectors, these so-called climate policy relevant sectors and other. What you see is it's pretty interesting to note that the potential for your firm to be high emitting is partly a function of its sectoral attribution, but actually it's actually almost as importantly where you lie within your sector in terms of the emissions efficiency. So obviously manufacturing and mining and quarrying are particularly emissions intensive as a whole, but the firms are hugely vary within this range of emissions intensity. So if there were to be, say, a credit rating agency or financial market shock from any other source, policy, technological shifts, it could be very much differential within sectors too. So with that in mind, I've presented to you the next slide, just to transition out of this idea of exposures and giving you the basis for the starting point for where we are, passing over to Spyros, who then will take this forward in an integrated framework where you look at transition and physical risk together. Over to you, Spyros.
Thank you very much, Paul. And thank you for giving us the opportunity to present here. It's really great. So what we did for the climate stress test, you might have seen the publication of the occasional paper in September, is it was really important for us to start with scenarios that capture very closely the interplay of both physical and transition risk. So in this whole climate stress testing exercise, the way that it's set up, there's no way to identify or isolate the impact of physical or transition risk, but we focus on the interplay and how the levels of one kind of influences the dynamics of others. So to do this, we worked with the NGFS scenarios. So we based our scenario work on the NGFS scenario outputs. And this slide basically gives you the narrative of how these scenarios work. And we focus on 3 scenarios, basically. The first scenario, which we use as a baseline or reference scenario, usually in our stress testing work, we present results as a difference from this reference scenario. Here we operate with an orderly transition where we assume that the climate policies are implemented in an early and effective manner. Transition is smooth and gradual, and as such, the costs from the green transition to the economy are minimized. At the same time, climate change is successfully mitigated, and hence costs from physical risk, that is increased frequency and magnitude of natural catastrophes, is limited. So in that sense, we have both a limited transition and physical risk. On the other end of the spectrum, we're working with a hothouse world scenario, where we assume that no new climate policies are implemented, only the current policy mix is considered. And at the same time, the emission reduction targets announced by states and sovereigns are not met. So we're dealing with a very limited transition cost, because the transition actually never takes place in the scenario. So hence, the economy suffers from extremely high costs of physical risk. That is, after a certain point in time, the increase in magnitude and frequency of these catastrophes becomes so high that the impact on the economy is extreme. In the middle of the two, we're working with a disorderly transition scenario, where we assume that policymakers do start the transition, but the transition starts in a delayed manner. So you can assume, and you can think about this as the transition taking place 10 years later than the orderly transition. And because they want to compensate for lost time, policymakers implement policies in a more aggressive and strict manner. That is, transition costs are high in this case. However, policymakers do get the policy mix right, and they successfully mitigate physical risk. However, because of the lost time, there is an increase in physical risk. So we're working with kind of a high transition cost, average physical risk cost scenario. So going on the next slide, please. Just to give you an idea of how the macroeconomics of these scenarios work. Now, the NGFS scenarios, we're working with phase one. That is what the publication in the summer of 2020. Their main macro output is in GDP. And the way that these scenarios work is not really an Armageddon case where climate change leads to a deep recession, but rather they model a steady state of the world where the economy keeps growing with the rate that it was growing before. And any deviations from this growth path are due to climate factors only. That is why it's quite useful for us to look at the differences across scenarios rather than focusing on the path of the GDP, which is the chart on the left. As you can see, it's always growing. And instead, our focus and perspective in the stress test is at the chart on the right. That is GDP deviation from the orderly transition scenario. And then you can very clearly see that in the beginning, when the transition starts on the year 2020, the world is better off with a disorderly or hothouse world scenario because the costs of the transition are higher than the ones from no transition. And going forward, we see that this trend reverses. The costs from the transition are more than compensated by long-term benefits. And as we go through time in the horizon, the disorderly transition becomes more costly because the transition happens later, around the year 2030. However, even there, the cost of the transition by the end of the horizon, which is the year 2050 for our stress test, are compensated by the very high and extreme physical risks we face from GDP. So that is, by the year 2050, the hothouse world is the worst option for the European economy, as the level of GDP is the lowest compared across the three scenarios. In other words, what we observe is that the orderly transition is the first best option, as both transition and physical risk costs are minimized. Now, going on to the next slide, please. Just to give you an idea of how we structured this exercise. So when we started looking at this stress test and what we want to do, we realized that climate risk is a very different animal to what we're used to assessing. That is, we needed new models to derive ways to capture credit risk because the models that we had in place for standard stress testing were not enough. Essentially, this exercise or stress test is a PD forecasting exercise where we try to project climate-adjusted PDs over the next 30 years for corporates first, and then we translate that to get the probability of default of bank loan portfolios. At the same time, we use the PDs then to reprice corporate bonds held by banks. Given the very granular data set that Paul described earlier, we're able to capture various risk drivers of climate risk on financial performance. On the transition risk side, we work with the carbon costs. For example, how much would a company have to pay if a carbon tax were introduced? So in this case, in the GFS scenarios, what we have is an increase in carbon price, but we don't know the policy mix that is driving this carbon price. And essentially, we translate this as a flat carbon tax for all. We also try to capture the impact of transition on the energy efficiency and the impact of technology, as well as how much it would cost for a firm to transition and switch from old technologies to new. Using very granular data on scope 3 emissions, that is the emissions associated with the use of goods sold, we're able to also capture demand side dynamics and how much would demand for carbon intensive goods change due to a shift in consumer preferences. On the physical risk side, given the very granular address level scores that we have, we're able to capture and project expected damages to physical capital from increased natural catastrophes. And at the same time, how much would this damaged capital disrupt production? That is decrease in output because of lower physical capital. At the same time, we also try to capture how much money would be required to recuperate this lost capital, that is diverting funds away from investing in production and expansion of output into recuperating the damages. We also try to capture mitigants and amplifiers of physical risk. In mitigants, we use insurance coverage data that is on the country level because we don't have granular insurance coverage here. That's an area of improvement, as Paul mentioned earlier. And also amplifiers, that is, we try to project an increase in insurance premia for firms located in areas very vulnerable to the physical risk. Now, all this is modeled together to capture two key drivers actually of PDs, which is profitability and corporate leverage. And these two are the main influencers and the main variables that influence corporate PDs, and then we translate them onto banks' balance sheets. Now, going on the next slide, you can see some results for different sets of corporates. Now, these we try to map these results into three buckets, that is three different bank portfolios, let's say. That is firms that are very low risk from transition and physical, firms that are carbon intensive and high physical risk. Now, for the low risk firms, what we observe is that at the beginning of the horizon, as the transition starts taking place in the orderly scenario, there are short-term costs. That is, the hothouse world and the disorderly transition probabilities of default are lower than the orderly transition. That is because the orderly transition now has an increased carbon price, and there are climate policies in place that bring additional costs to firms, and also they need to borrow to invest in transitioning and decarbonizing the production process. However, as time goes by, there are long-term benefits because these costs are more than compensated. So, for example, assume that the investments in green technologies and the adoption of green technologies lead to huge benefits in energy efficiency and overall production cost efficiency to firms that boost their profitability and hence lower probability of default. As time goes by in the horizon, those costs from increased physical risk tend to magnify even more. So the distance of the hothouse world PD to the orderly transition becomes even higher. So there are two sources of long-term benefits of the transition. One is through the investment and the development of new technologies, and also the fact that physical risk costs, if climate change is unmitigated, are keep increasing, and they increase over time. In the disorderly transition scenario, obviously, at some point, the relationship between the PDs across the disorderly and orderly transition sometimes flattens out, because even in disorderly, these transition costs are more than compensated. Now, looking on the chart in the middle, which is the more carbon-intensive firms, the ones we assume that have faced higher transition risk because it would cost them more to decarbonize the production process, the short-term costs are amplified. However, the long-term benefits are still there. Obviously, the cost of transition is higher, and also, as you can see, the disorderly transition scenario for some years is even more costly than the hothouse world. However, in the long run, physical risk still dominates, and basically the PDs are always higher. Now, looking on the chart on the right, which is probabilities of default for the high physical risk firms, these short-term costs of the transition are very small. However, there are massive long-term benefits over an early transition. And what is very interesting to observe here is that those firms that are already very exposed to high physical risk, after a point, right around the year 2040, that they reach a point of irreversibility, where whatever they do, it's very difficult to return to the PDs of the past, because you cannot change climate patterns. So physical risk basically increase continuously. And if we were to expand this chart to the years 2060 or 2070, we would still observe this line continuously increasing, because physical risk damages just keep getting higher and higher. Now, going on to the next slide, please. Now, translating these results to the bank portfolios, we observe very similar dynamics. Again, the orderly transition is the first best option. There are short-term costs. However, the long-term benefits are more than compensated for these costs. Similarly, the hothouse world is the highest. And what we observe is that physical risk is concentrated in a few regions, let's say. Now, looking at the chart on the right, which basically shows the country level, the box plot on the right shows the country level deviation from the Euro area average change from hothouse world to orderly transition. And what we observe is that there is some non-linearity in physical risk, because those countries more affected, already more affected by physical risks, so think of the Southern European countries in the map Paul showed earlier, will face very high physical risks, which is expressed in a non-linear manner. So overall, the risk for banks on average is on average low, but it is concentrated in those countries that are more vulnerable to physical risks. Going on to the next slide, please. Now, there are some possible financial stability implications, and we do have some reasons of concern here. And that is, if we are to look on the evolution of banks' credit portfolio PDs for those banks most affected, that is the 10th percentile of PD distribution, what we observe is that in the hothouse world, the increase in PDs is massive, and that is 5 times more than the average bank. So those banks most exposed to physical risk would see a change in PDs in the hothouse world scenario, which is 5 times higher than an average bank in the hothouse world. And what is very interesting to see from this chart is that if you look at the dotted line, that is the average bank portfolio PD under the orderly transition, is that the probability of default is even better than the starting point. So there are cases where the orderly transition can actually make you better off than when you started. And for these very vulnerable banks, they're actually quite relevant for the system, because those 10% of banks account for 20% of the exposures. So these are very relevant banks that we're talking about. They're fairly big, and they do have a fairly large balance sheet when compared to the overall Euro area banking system. Now, going on to the next slide, please. So we also did a similar exercise that we did for PDs, we did for LGDs. And the way we project and model LGDs is through 2 channels. One is the macro channel, which captures the sensitivity of LGDs to macroeconomic condition. This obviously includes both transition and physical risk, and Kata will share more details on how this sensitivity is modeled. And then we have a micro channel, which is the depreciation of physical collateral values from increased physical risk. So imagine the devaluation of physical collateral because of increased magnitude and frequency of natural catastrophes. And if we translate that to the box plot on the left, what we see is that, again, hothouse world LGDs are higher than the other 2 scenarios, and there are some countries that face extremely high increase in LGDs. Obviously, given the relevance of physical risk in the hothouse world, we observe that most of these dynamics are coming from the micro channel and the physical collateral types. Going on the next slide, please. Essentially, this chart puts together the PDs and LGDs that we modeled, translate them in expected losses. And again, what we observe is that the losses are highest in the hothouse world. So the orderly transition is still the first best option. And there are some countries that are more exposed than others from physical risk, even when looking at expected losses in banks' portfolios. Going on to the next slide, please. Now, we did a taking our PDs, we translate that into corporate bond repricing. So we looked at the corporate bond portfolios of banks, and basically repriced the securities based on the PDs of issuers that we modeled and I showed you earlier. What we see is, again, very similar dynamics. The hothouse world leads to the highest price shocks. However, these shocks are quite negligible because the corporate bond portfolios of banks are quite small. Like, you can think that about 78 significant institutions in the Euro area, that is the largest banking groups, hold about 80 billion of corporate bonds when their total assets are around 30 trillion. So again, quite of a small impact here when looking at the broader system. Going on the next slide. And now I will pass it on to Kata to talk about how we extend these scenario analysis to the broader financial system.
So let's move directly to the next slide. And here is the game. So what Spyros was discussing in quite some detail is to the left of this slide. So these are the works conducted at ECB in Financial Stability Department. And this is like our headline project, which is this top-down economy-wide stress test. However, what Paul was referring at the very beginning, and he was like alerting you that we work, toward like a 2-pillar approach. And in the second pillar, and this is what I will focus on, we have a history of 2 exercises, to be very precise, and I will focus on the one which corresponds with 2021, in which we ran a coordinated stress test for banking, insurance, and investment funds. And just as a token of recognition, on the right-hand side, you have also the activity which is going on in our ECB banking supervision, which none of us touches yet because it will be published only looking forward. So let's move to the next slide. And this is what we faced when we were approaching our project a year ago, more or less a year ago from now. So we looked around in all institutions, so European institutions, which go under the umbrella of ESRB, and this is quite the same scope of European Union. And we ask ourselves the question, like, what type of exercises, stress test exercises relating to climate they are conducting. And the two tablets you can see here, I mean, summarize the main messages. So if you look at the first exercises targeting climate risks, and this will be those who are like the smallest bars to the left, the shortest bars, so to say, in each of the panels, you will see that the initial exercises tended to be very much focused on transition risks. The later the exercise, the later the publishing date of the exercise, the more we see this focus at shifting toward physical risks. A similar observation so you can make in terms of convergence of horizons. So the later the exercise, the longer the horizon. And this is the two tendencies are very much fostered by the increasing availability of NGFS scenarios, which Spyros was already discussing. And maybe last but least observations from this slide would be that what we also observed when looking at different exercises is the increasing interest of modeling physical and transition risks on a very granular level. Let's move to the next slide. And this is just summarizing 3 scenarios, and which are coincidentally the same scenarios which Spyros was discussing at length, which we selected for our exercise. It was the orderly, good scenario, the disorderly scenario in which policy phases in bit too late to not to be disruptive, and a hothouse world in which policy inaction leads to higher physical losses in the long run. And the next slide, and the next element I was mentioning initially. So what do we mean by the shift toward use of more granular data? So if we cast ourselves 2 years before from where we stand now, we are very much in the world to the left. These were the first steps in stress testing for climate risks. We usually had some macro financial scenario described in terms of GDP, interest rates, you name it. Then we were trying to map this macro financial scenario into sector level scenarios, think in terms of different industries. From these scenarios, we were mapping it into, let's say, probability of defaults for those industries. And then we were finding out what's the impact on the banking sector or insurance sector. In the world we are in now, it starts the very same way. So with microfinancial scenarios, which we map or not in sector level scenarios. But what comes next is not PDs for sectors, but more a firm level detailed balance sheet analysis. And only by looking at firm level outcomes, we map it later on to bank firm level PDs and later to outcomes of the banking sector. And this is very much the approach which Spyros was referring with our EU economy-wide stress test, but I will give a few more examples of this approach. So if we shift to the next slide, this is just, again, probability of default, different data set, different capacity in terms of the sample, in terms of data type. And you can see that we estimated a small model for probability of default using granular sector level exposures. And we track how the PDs in 2 NGFS scenarios, orderly and disorderly, move across time, and also within the breakdown to low carbon industry and higher carbon industries. So first observation is that in both scenarios, the probability of default slightly increases, but it increases particularly strong in the disorderly scenario and for carbon intense industries. So again, different data set, different approach, but the very same messages Spyros was already flagging. Another example, in the next slide, this is firm level information, and this providing a bit more of an intuition how these things work. So what we did here, we took exactly the same scenario, orderly and disorderly, and we mapped it into firms' expenditures on carbon allowances. And you can see these expenditures growing sharply at the end of the horizon in disorderly scenario. And this maps into sharp drop in profitability of companies in the disorderly scenarios compared to the orderly scenarios, resulting presumably in higher PDs of corporate sector. And last example, this will be this time not about probability of default, but loss given default. So let's move to the next slide. So we use unaccredited data, so credit registry, and we try to learn what would be the evolution of loss given default, and very similar picture as to probability of default. So we will tend to have higher loss given default for high carbon industries, and especially sharply increasing in the disorderly scenario. After those few examples, let me move to the core of the exercise, in which I will prove that, let's say, the analysis which Spyros was the briefing on the banking sector is possible to be done also for the whole financial sector. So our aims were moderately ambitious. We wanted to take NGFS scenario. We wanted to focus on disorderly scenario, and if possible, also on the hothouse world scenario for all sectors of European banking, like on European financial sector. So it is a banking sector for which we had much narrower sample of banks than Spyros was referring, but we had very good data on their exposures. We had insurance sector with very high coverage and investment funds. All three exercises focused mostly on the asset side, and banking sector exercise focused mostly on credit risk losses, whereas insurance and investment funds stress tests focus on market losses. And let's have a look in the key messages. Banking sector in the next slide. So what you can see here, and it very much corresponds with what Paul was talking about, the concentration of exposures, like let's say concentration of exposures, carbon intense exposures in the banking sector. We see generally moderate overall credit losses of 1.6 percentage point on a portfolio of large corporates. But what is interesting in this is maybe not the absolute losses in the disorderly or hothouse world scenario, but their distribution across different portfolios. And we see that the quite substantial contribution of losses in electricity sector or real estate sector, in both disorderly and hothouse world. And interestingly, when we move to the next slide and we look at the insurance sector to the left and investment fund sector to the right, we again see losses which are moderate by stress testing standards. So it's 0.5 percentage point and 1.3 percentage point correspondingly. But what is interesting is this concentration of losses again in oil production, in gas production, in production of vehicles for insurers, and correspondingly in energy sectors or basic materials for investment fund losses. So what we concluded from this exercise is this, that for all parts of the financial sector, we mark this even forward-looking concentration of losses. We learned from this exercise that we might want, for future purposes, think a bit more about dynamic balance sheet and trying to accommodate this longer horizon of relatively long horizon NGFS scenarios, also from the point of view of adjustment of the financial sector. And what we've learned from this exercise, message number 3 maybe, is that granular information helps not only diagnosing what is the current exposures of the banking sector, financial system, or financial sector more general to climate risks, but it also helps us to model the forward-looking impact, be it via the small models I was showcasing, or be it by plugging different scenarios to and connecting them with the information about the current exposure level. I pass back to Paul.
Thanks, Kata, and sorry about the vaudeville show style switching here. We're doing a bit of technical issues on the side, so we're sharing a screen. Look, I would take it then forward to indeed these main takeaways slide, which is the last one of the presentation. Now, there's been a lot to unpack here. Obviously, we've listed where we can the publications and the links, because I think there's a lot in there, and we've tried to be very transparent as we move along this path of learning a bit more about this intersection of climate with economy and finance. So there's a lot in there that obviously we've not captured, but you're welcome, of course. I hope I give you a bit of a teaser to go read. Maybe what I'll try and do, though, is consolidate and bring this down into two main takeaways. So the first is really, if you imagine a systemic risk as a two-dimension of cross-section and time series dimension, that's largely where I'm going to focus. So first in the cross-section, and it's this idea that you have this risk concentrations. And the risk concentrations are, of course, geographies, so regions, on the side of physical risk, and the transition risk mainly on the side of sectors. But I think it's insufficient to think that economic sectors alone will give you an impression of the distribution of prospective risk to policy changes, technological shifts, or sentiment. But largely you have to look at the firm level. And I think a lot of, hopefully what we've drilled home today, is a lot of the action is indeed at the level of firms. And it's very granular data sets to help us to scratch at that element. The second dimension, other than the cross-section, of course, the time series dimension of systemic risk. And here we see some more elements of path dependence. And that is basically that these forward-looking analyses that build on advances in terms of measurement show us this idea that you have these net benefits when you start to trade off transition and physical risk to thinking about earlier action to tackle from the policy side, the technological side, and the like, longer term risks associated with physical risks. And that those start to become obviously physical risks more dominant as you move into the horizon, maybe 10 to 15 years out, start to become very dominant from the charts you saw from Spyros, for instance. And that the distribution of risk within that transition is, of course, very much borne by the highest greenhouse gas emitting sectors or firms. Now, with these two main takeaways in mind, just before passing the floor back, I just mentioned, of course, this is work in progress. You see the italics here. And I think two things really do still concern us in terms of how we want to move forward and ensure that we have sharper measurement, more robust measurement. And the first is that issue of measurement uncertainty related to particular geolocation, but it's also this idea that systemic amplifiers may be there in terms of what we're seeing in terms of measurement. We want to make sure that we try to capture as many of these as we can. So quantity and quality of data matter, but also modeling, of course, is really important. Now, much of what you've seen today has to do with direct impacts. Because there'll be a lot of indirect impacts through second round effects, non-linearities, value chain impacts, and the like. And I think that the point of Kata about dynamic balance sheets is important. To hold the balance sheet fixed over a multi-decade horizon is a pretty heroic assumption, but to come up, of course, with a dynamic balance sheet also requires, I think, a careful elucidation of the assumptions that are inherent there, and to allow that interplay to take place. Because absent that, of course, the systemic amplifiers might only be imperfectly captured. With all of that said, that was it on our side for now. We're happy to take up questions in the session. All three of us are here, so back to you.
Well, Paul, Kata, and Spyros, that was really impressive. A lot to absorb there. We do have a question in the chat. Maybe I'll pose that first if you think you can probably all see it, but I'll read it. Insurability of non-diversifiable risks is limited. Insurance may not just be expensive, it may become unavailable. We can't just shift physical risk from one financial sector to another. How did you integrate this into your analysis of mitigants?
Okay, so excellent questions. What insurers indeed are pretty good at, and we've noticed they are very much advanced in the sphere of financial institutions in modeling physical risk of climate, is systematic risk. But of course, systemic risk might fall a little bit less out of their purview because indeed the idea of diversification, which is a bit less present if you have these correlated shocks. So for the time being, again, as part of a learning exercise in building blocks, the work that Kata presented in particular was building on separate analyses of the banking sector, the insurance sector, and the investment fund sectors without the interplays necessarily. What we did have within this, of course, is that insurers tend to be holders of investment fund assets. And around, I think our estimate is around 30% of those assets are held by sort of longer term investors. So it can be, of course, direct spillovers. But again, it's more into the sphere of direct impacts. Now, in this current phase of work where we're advancing at the moment, I'd say we're thinking a bit more carefully about these systemic interplays. But of course, even if you abstract from climate and just think about the financial and economic terms, we're still some ways off, I think, from credible system-wide stress tests. It would require a model which is fairly canonical, and we don't necessarily have as well developed as we like at this stage roller feedbacks. But that being said, I think it is our homework as we move forward to think about these interplays as we go forward, because ultimately risk will be distributed throughout the system in different ways, and that can reduce or amplify systemic risk. But to think that risk can be purely eliminated through cross-sectoral diversification probably is unlikely in this situation. I don't know, Kata, Spyros, anything to add? We'll maybe leave it at long-winded answer on my side. Back to you.
Oh, that's great. That's great. I know Rob has some questions, and I do too. So, Rob, why don't you go ahead?
Well, I have a whole page of interesting things I'd like to pursue with you, and
Same here.
I'm not quite sure where to begin, because there's you gave us so many things to think about, and I guess just for starters, these three scenarios that you're looking at, you know, when we look at them from the US point of view, it looks like Europe is way ahead of us. Europe has the ETS going, and its coverage is fairly widespread, and it is getting to be to more so. So I guess I wonder, is the hothouse scenario really, does it include the ETS? And does it include some assumptions about how it's currently being operated? Why does it look so bad when, in fact, you know, we would say at least Europe is making a lot of progress in this direction?
And just if I could add to that, on the other side, you know, what if Europe and say some of the other advanced economies embrace the orderly or disorderly scenario, but others don't? For example, China.
These
good.
are
Spyros, I'll let you take up.
these are two excellent questions. So on the hothouse world scenario, so yes, the ETS is included, and actually, if you look at the variable outputs of the NGFS scenarios, there is a positive carbon price in there for the hothouse world. And actually, if you look at the emissions of Europe in the hothouse world, they actually go down about 20 or 30% by 2050. However, they remain flat, which means that their emission reduction is not enough to cover for the increased physical risk. So you can understand that for Europe, which, as you said, is way ahead of the curve in terms of climate policies, the hothouse world has the minimum impact when compared to other jurisdictions. So in the US or China or India, the hothouse world is actually even worse. And in India, for example, I think emissions even increase in the hothouse world. So it's very interesting to observe these dynamics. The way that these scenarios work is basically a reverse engineering exercise, which is we have a temperature target at the end of the horizon as a narrative, and then we backward engineer the possible scenario paths that take you there, taking into account the current policy mix. And obviously in Europe, the current policy mix only takes you to a certain extent. It doesn't resolve the problem. On the international cooperation part, the NGFS scenarios actually assume perfect coordination across countries. That is, you know, they all introduce their necessary climate policies at the same time. Again, as I mentioned, the policy mix in the NGFS scenarios is unknown to us. They just assume that the right policies are implemented to reach the necessary carbon price that will take you on the necessary emission pathway according, and that is relevant for the scenario narrative.
Yeah, can I just add, Spyros, to that? And I think that's the perfect answer, just to say, the NGFS we've chosen has become sort of an industry benchmark scenario for running climate analyses around the world. But of course, as always with scenarios, the consistency and the relevance are often a trade-off. So obviously the relevance of a European specific scenario might be something we need to consider as well in some more bespoke exercises here in context of our own Fit for 55 packages. And we'll be taking forward, obviously, as we in the course of the coming year as well. But for now, we wanted to present to this NGFS one because it's the most internationally consistent one we have for now.
Yeah.
There's a question in the chat, Rob, and I'll come back to you and maybe some of mine, but the question in the chat relates to human capital. To what extent can you incorporate into the analysis degradation of health as a consequence of increasing climate-related risks?
I think, Spyros, you're a point man on biodiversity and all things that are not strictly climate. So I'm going to over to you unceremoniously.
Yeah, so we haven't modeled that in our, at least in our stress test, and I don't think the NGFS scenarios include this in their transition risk modeling. However, what I know is that there are human capital considerations in the physical risk modeling part of GDP. So that is, how does heat stress and chronic physical risk affects labor productivity, and then the impact on the macroeconomy. So I think from a human capital perspective, that is all that we have at the moment.
Thanks.
Yeah, and to be fair, just to mention that you probably noted from what much what we're doing is a firm level analysis. And obviously, the question on the cost for governments, largely that's still underexplored in a sense. And obviously, the health elements could be picked up also by these other sectors. And from a systemic risk standpoint, of course, sovereign step-in risk is a major one.
Rob, you want to go next?
Sure, thank you. I assume that there is some analysis of these probability of default functions. I think you've probably estimated them with maybe physical risk and sector information and so forth in there. I guess I'd like to know, how you did that. But it seems to me, assuming that's what you've done, one of the expectations that I guess I have is that a lot of the physical risk seems to be more severe in the southern part of Europe. And we tend to think that companies are less productive in the southern part of Europe. And is that really is that what you're estimating? In other words, is physical risk look serious because of really the sort of the productivity gradients across Europe? And are there multiple explanations for that besides just physical risk? And I guess then the question is, how would you validate these methods? Well, one way is, I think that you've said that you can evaluate the value of a loan to some particular granular company and by discounting back the losses that they have, or maybe the PDs that you've calculated. Do you ultimately compare the values of those loans with any kind of market numbers? I mean, you could do this with bonds, and you could see whether the bonds are really priced differently for investments that have more of your physical and transition risk than you expected. And if so, then you'd have an idea whether investors were paying more attention to the hothouse scenario or the disorderly scenario or the orderly scenario. Maybe we would learn something about how climate is priced in the bond market. That's not just one question, I guess.
You want to pick up on the first one, Spyros? I can say a few words about what we've seen about financial market pricing, at least now. You go ahead though with the first part, maybe, if you want.
Yeah. So on the productivity differences across these countries. So in a sense, we don't model them explicitly ourselves. So the way that this is this is on the GDP impact, for example, the NGFS basically calculates damages across Europe, and then we basically disaggregate them according to the very granular physical risk scores and exposures that we have for the countries. And in a sense, what we do and in our modeling, it comes into calculating the expected damages from acute physical risk. That is, how much do you expect to lose in terms of physical capital over the next 30 years from floods, wildfires, and sea level rise? How that then affects output, because now you have less physical capital to produce one unit, the unit of output that you were producing before. And then how much does it cost to recuperate and repair this physical capital, the non-insured part? So in a sense, these are more direct impacts that we're modeling rather than only the labor productivity. The productivity enters a picture through the GDP, because obviously GDP is used to calibrate those PDs. And again, as far as the NGFS is taking into account these productivity, this heterogeneity in productivity across country, we are incorporating it, but we're not modeling it explicitly. So I'd say that the physical risk impacts across countries is more on their exposure to acute hazards rather than on the productivity.
And just to add to what Spiro said, and a couple of things. So one is a colleague here fortuitously had done work on earthquakes in New Zealand and published quite a bit. And what he found is the insurance, effectively insured versus uninsured losses have a major difference in terms of the GDP impact on a macro aggregate level. So you often find actually post sort of catastrophe that you might even have GDP increases, which are pretty important and outweigh the losses you actually faced on aggregate. But of course, it's all depending on insurability. And it gets back to the point I think we were trying to raise during the seminar, that the insurance protection gap is potentially quite meaningful when it comes to more systemic shocks. So this cross-sector interplay you're asking about earlier is something I think we need to delve into a little bit more deeply. The second point was on financial market pricing, at least what we have in terms of what we measure now, and I think surely you've seen a lot of seminars, your side of the Atlantic too, is this greenium or the differential in terms of the pricing, be it physical or transition risk, seems to be relatively small for the time being. So in earnest, if we would expect bigger price impacts in markets, I mean, there's still probably yet to come. I know there's a wide range of studies, so I condition this and it depends on the sample, but we still don't see, at least here in Europe, too much by way of a huge basis point impact of greenium on market prices.
I've got a couple related questions, if I could kind of jump in. One, you just mentioned the greenium, and I wonder whether or not you think the greenium is the result of a lot of money piling in the technicals, if you will, into green bonds relative to the supply. And that's what's one of the things that's driving the greenium as opposed to the fundamentals that might be influencing the price. But what Rob was referring to indirectly is some of the work that we've done, which would be interesting to sort of compare the results that you get with some of the things that we're getting in our C-risk measure, because that might, and particularly the rankings among institutions, if you're doing that, would be interesting to compare those things to see whether or not the work we do based on market pricing and market data would be comparable to the kinds of results that you're getting. But a couple of related questions. One is, how are you calculating transition costs? And to what extent is the transition anticipated in markets? And that relates to the thing I just mentioned. Because if markets tend to anticipate the cost of transition and firms are acting on the basis of that, then that might change the calculation of the transition cost. What we see now, for example, is that a lot of the fossil fuel firms are deciding to return money to shareholders rather than invest it in new production. And so that might raise the cost of the transition through either, a more disorderly or higher inflation scenario, or one that's less advantageous. And then a question about insurance companies. And you mentioned wrong way risk. I mean, it seems to me insurance companies are sort of the poster child for wrong way risk, in the sense that, their liabilities are going to increase in a climate related scenario, but the value of their assets or collateral will decrease. And so, just as when interest rates change and they've faced things on both sides of the balance sheet, in this case, are they the most at risk, even more perhaps than the banks, whose assets may go down in value, but where the liabilities don't change or are supported by the government? How do you think about risk in insurance companies and spillovers to the rest of the financial system?
Okay, two big questions. Well, at least a couple of questions I quickly touch upon. Greenium, I think it's a selection bias question partly too. So the work we've been doing, the econometric work, suggests that just the presence of a target and the self-selection might have into green bond markets or ESG markets might condition very much like greenium. So it's indeed, I think, an excess demand story. It's also presumably a story about the sample. And if you widen that out in terms of issuance, I'm not sure it will hold. And the second point you made about model risk, I think you're talking about your C risk, if I'm not mistaken.
Yeah.
And the related. I think it's good to, we have no one model which can tell us a lot about the future, particularly decades out. So the more we can do these model comparisons, I think the more we can minimize the model risk associated with a specific approach. So I'm all for the comparisons. Lastly, on the side of insurers, fully concur on about this wrong way risk being relevant for them. Obviously, there's a couple of things we are very much concerned about insurers. One is the ability to protect themselves, And the second is this dual materiality. Will they actually worsen the climate transition for everyone by ranking out, getting premiums much, much higher, reducing the availability? So in both, the second round effects which would come from that, I think we're not there yet in terms of modeling. It's still on our to-do list.
Okay, there's a long question in the chat, which kind of relates, a couple of them now. One relates to sort of the global nature of this, which we raised before. If climate change is, kind of reducing the level of GDP, I mean, one related question is, on a global basis, how do you factor that into the model? Is it reducing, productivity? Is there less? Are there fewer resources available for investments? How do you quantify the costs if you're trying to grapple with compensation costs to developing countries and the feedback among countries? That's one question. And why don't we tackle that one while I digest the second one?
Yes, I think it's still pretty Europe focused. No, I don't think we have much about the cross-country, particularly emerging market angle yet.
Right.
Yeah, indeed. And if I can give a bit of flavor, very high level of how these macro models work is, as I said earlier, basically you have your temperature target on the narrative, then they backwards engineer the emission paths that get you there. Then there's an increase in the carbon price that affects basically the emission pathway, and then that trickles down to the energy sector. So all the basically macro impacts from transition is the transition costs associated with the energy sector, energy production.
Right. And then another question in the chat relates to your comment, Paul, earlier about how they found in New Zealand after earthquakes, the GDP actually went up because of the cleanup is sort of the broken window idea. But the damage from global warming and from climate-related risks is sort of global in a sense that it's hard to diversify, and you're going to have to spend a lot of money, which may boost GDP, by the way, a lot of good investment in resilience and making societies and economies more resilient. How do you think about that aspect of it?
Yeah, so I think it's a systemic versus systematic point still. I mean, much of the evidence we have from event studies are still in the systematic
Right.
sphere, where it's very specific shocks. And keep in mind, all of the physical risk hazards we presented from flooding is quite a localized event. And it can be quite damaging, not to downplay this shock. When it comes to riverine floods, which we're concerned about. We didn't talk much about sea level rises because that's going to affect a whole different swathe of urban population.
Sure.
And even countries, which could be completely underwater, literally and financially. So these types of things which come later in a century, lack the 20-year horizon look forward we had, could be hugely damaging and largely uninsurable likely.
Yeah.
And the distribution of insurance anyway is something we have to concern about. If in Europe, where 35% of economically relevant exposures are insured, think about emerging markets and how that could potentially play out in terms of
Absolutely.
So all told, I didn't want to sort of downplay or undervalue the estimate of this New Zealand example. It's to tell what the event studies do show is it perverse sometimes in terms of outcome. But you're right, it could get much worse in the case of correlated shocks.
Sure. Well, this has been fantastic. As Rob said, we could go on all day here because we've got lots of questions and you may have some answers. But in any case, exploring them together, I think is really going to be fruitful. And we look forward to further engagement. So thank you very much for the presentations, Paul, Spyros, and Kata. And we look forward to engaging with you again. If we get other questions from our participants today, we'll relay them to you. But this has been really great. Thank you so much.
Thanks a million. Much appreciated.
Thanks.
Thank you very
you.
much.